What's the difference between a professional and a retail investor? This is a cool question because it's very theoretical, but it's so real. This issue comes up for me all the time, and really it's part of how I talk to prospective investors in deals. 99% of people in this country are retail investors. That means that they go through some broker, intermediary, or somebody else to access the markets. They don't have great understanding of those markets necessarily. It might be a doctor or a lawyer or an accountant, somebody who's busy full-time doing some other activity, whatever their full-time activity is. It could be anyone in any walk of life, and they could just be wanting to access some investment opportunities, but they're really not focused full-time on investing the way professional investors are. Retail investors tend to be much less thorough than they probably should be. Most of these people buy things and they hope that they go up. Hope is really the key word. I won't tell you that happens to everybody, but I sure know that an awful lot of people, mostly people who lose money, are losing money because they hope something is going to happen instead of knowing for sure exactly what's going to happen. And that's really the big difference between retail and professional investors. It's not that professional investors have a crystal ball that's any better than anybody else, because the batteries in my crystal ball, I need to go to the store and replace them just like everybody else. They don't work. But here's the thing. Professional investors study, they analyze, they research. Now, if they're betting on stock market types of activities, are they going to get it right all the time? No, they're not. But in real estate, what's really different about real estate is that we have the ability to control the outcome of the investment. If we know that all the properties in a certain area sell for 100 and there's something for sale for 50 because it's in distressed condition, and we add a certain number of dollars to that, we know that we can bring that value to about 100 like the other properties in the neighborhood, maybe for adding 20 or 30, so there'll be some margin left over. So we have almost an assurance that we can accomplish what it is that we want through the efforts, mentally, emotionally, physically, all the efforts that we put out. We know that we can control the outcome of that investment. That's what professional investors do. They control the outcome of their investment activities, and that's what's really different between professional investors and retail investors. So retail investors like to get onto the back of professional investors because professional investors just have an edge in the marketplace. They know things that other people don't. They take actions that other people don't, and they get outcomes that other people don't. And that is exactly what retail investors want. And that's the reason why when they come into a fund or another kind of structure, they want to put up cash in exchange for a share of profits. So the promoter is happy to get that share of profits, and the investor is happy to give that share of profits because they wouldn't get it but for the efforts of the promoter, sponsor, syndicator, fund manager that's producing those profits for them. So those are some significant considerations. I hope that as you're talking to retail investors, this helps you to get some clarity, because that's really a significant component in how you raise your money, is understanding this differential. In the meantime, this is a great business. Now go out and stake your claim.